When an investment takes off, our brains are wired to celebrate. We watch the ticker climb, we calculate our paper wealth, and very quickly we tie our own identity to that rising number. We fall in love with our assets. That same affection becomes toxic during a market crash. When the numbers plummet, retail investors often freeze. Instead of cutting their losses, they hold on to falling assets out of a misplaced sense of loyalty to the companies that previously made them feel successful. And this psychological trap scales directly with wealth. As the portfolio grows, so does the anxiety. Highly successful people often end up trapped in a state of miserable fear, terrified of losing their newly acquired societal status and net worth. To achieve extraordinary financial returns, you have to defeat your most basic human instinct. You have to entirely disconnect your emotional state from your financial outcomes. Samit Vartak understands this disconnect better than almost anyone. He didn't start on Wall Street. He grew up in a rural farming community in Maharashtra, India, with a father heavily burdened by debt. His journey out of that village was an absolute fluke. He applied to an American MBA program using leftover forms from a friend and managed to land a scholarship to Washington University. After graduating, he took a highly unconventional path. He returned to India, accepted a 70% pay cut to enter the investing world, and eventually built SageOne Investment Managers, a firm that now manages a portfolio of over 8,000 crores. His firm regularly generates 20 to 25% returns. But that outperformance doesn't come from a fancy pedigree. It is the direct result of a strict, meticulously calculated system of psychological detachment. Vartak's strategy begins with a single baseline requirement. Before he even looks at a stock, it must mathematically demonstrate the potential to double its earnings within 3 to 4 years. To find those specific companies, he relies on the 20-20 rule. This balance sheet diagram outlines the criteria. A business must show an expected earnings growth of 20% and a return on equity, or ROE, above 20%. That return on equity metric is crucial. It means the cash the company generates internally flows straight into expansion. They can fund their own capital expenditure without taking on a single dollar of external debt. Applying this ruthless quantitative filter immediately removes the temptation to fall in love with a compelling narrative. If a company has a great story but lacks the internal math to survive and grow on its own, it gets cut. Generating total returns of 25% over the long haul requires capturing outliers. You need a few multi-baggers, stocks that return 5 to 10 times your original investment. Finding those massive winners is a strict probability problem. This scatter plot tracks a realistic portfolio distribution. Out of 12 separate investments, 9 will likely trend sideways or take a dip. Only 3 will break upward on an exponential curve. Because you never know which 3 will skyrocket, the portfolio must be aggressively churned. If a company's growth drops below 20%, it is sold. In a typical 3 to 4 year cycle, 80% of the holdings are turned over. But the hardest psychological test is liquidating a winner. When a beloved, high-performing stock reaches a valuation multiple of 40 to 60 times its earnings, the risk outweighs the reward. It is instantly sold. You cannot marry a stock. The underlying mathematics must dictate your exit, completely divorced from any affection you feel for the company's past performance. This emotional detachment is a massive advantage during macro market panics. Instead of seeing chaos, a detached investor sees routine, predictable 3 to 4 year crash cycles, revealing the bedrock underneath the turbulence. When the broader index drops 24%, the average retail investor panics and sells at the exact wrong moment. The detached investor watches the same drop and starts hunting for cyclical value. Amidst the panic, they ignore the negative sentiment and monitor the actual data. They look for companies actively paying off external debt, and they track surging corporate announcements for new infrastructure spending. By stripping away the emotion, you gain the clarity to identify a cyclical market bottom, while the rest of the world is completely blinded by fear. But what happens to the human mind when this detached strategy actually works, and immense wealth is accumulated? Often, the anxiety only gets worse. Modern capitalism programs us to operate on autopilot. We become convinced that our self-worth is entirely dependent on our net worth, and because that target is constantly moving upward, we never actually feel secure. Vartak addresses this through Advaita Vedanta and the parable of the Chinese farmer. In this story, a farmer's horse runs away, returns with wild horses, and then causes his son to break a leg, which ultimately saves the son from a deadly military draft. The lesson is that labeling immediate events as strictly good or bad is a fool's errand. Trying to control or pass judgment on the universe's daily outcomes guarantees a life of perpetual anxiety. True psychological detachment requires accepting reality exactly as it arrives. Under this philosophy, the purpose of money drastically shifts. It is no longer a societal scorecard. It is merely a utility, a tool used to buy personal bandwidth, free up your schedule, and secure your own time. The great tragic irony of the highly successful is that they let the fear of losing their money dictate their daily actions. If your wealth controls your decisions, you have willingly surrendered your freedom. The mathematical discipline of letting go is exactly what builds extraordinary wealth, but the spiritual wisdom of letting go is the only thing that actually makes you free.